everyone. Welcome to a new episode of In the Money with Amber Kanwar. Today, we're doing things a little bit differently. We're putting the spotlight on a small cap that's been on something of a rocket ship. Abaxx Technologies is a startup. It's an exchange targeting underserved markets, trading things like LNG, battery metals, and carbon credits. It's still pretty nascent. It barely has any meaningful revenue, and it's still losing millions of dollars. But the stock is up 240% over the past year, and it's now $1 billion company. And it's pretty stacked, backed by heavy hitters like Robert Friedland. The former head of Goldman's commodity team, Jeff Currie, is on the board. We find out what's behind the hype with Josh Crumb, the founder and CEO of Abaxx. And before we get into the interview, remember, we are still doing our swag giveaway all month long. If you want to win the market cap or the liquid assets mug, all you have to do is be a subscriber, comment wherever you're listening. We pick one winner every episode. Let's get into it. When you choose a Raymond James advisor, you're getting more than independent financial management. You're getting access to complete financial guidance under one roof, from tax and estate planning to trust services for generational wealth and strategies for life's key milestones like buying a home, funding your children's education, or preparing for retirement. They bring it together in one financial plan. What also makes Raymond James advisors unique is their complete independence. With no proprietary product to promote, you will benefit from personalized services, all backed by the strength and resources of Raymond James, a powerhouse with $100 billion in assets and over 520 advisors nationwide. Discover how Raymond James can help you live a life well planned. Visit raymondjames.ca. The content provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult with a qualified financial advisor or professional before making any investment decisions. Josh Crumb, thank you so much for joining me on the podcast.
Thanks, Amber. Good to be here.
You are an interesting individual. You've got a deep background in commodities. You're ex-Goldman Sachs. You worked with the Lundins. You've got someone very famous in commodities on your board in Jeff Currie, who was the head of commodities at Goldman Sachs, and now he's at Carlyle. And a lot of your management are kind of ex-Goldman, your chief economist, ex-Goldman, ex-Bridgewater. So you've got all these people with very impressive resumes, and you come together to build kind of a disruptive force when it comes to trading commodities. And before we talk about what that is, I'd love to know a little bit about the origin story and how this all kind of came together.
Sure, absolutely. So going all the way back very briefly, I grew up in Colorado, went to the Colorado School of Mines, actually went to university with Govan Friedland, and of course, Robert's one of our large investors as well. But I ended up in Canada working for Lucas Lundin, and obviously fell in love with the sector. So I've spent most of my career in Canada. I did go over to Goldman, really right just after the financial crisis, and really, even though I was doing M&A and obviously very, as a mining engineer, very detailed work, as I'm sure people are very used to in Canada. I did always have this macro bent to what I was doing, and was able to predict the financial crisis and set up the Lundin Group for hedging a number of commodities, and that's where I got to know Goldman and Jeff Currie. And then kind of after the crisis, I went over there to lead metals research and strategy for the firm out of London. And at that point is really where you really learn the intricacies of the market structure for commodities. So a lot of times we think of the oil price or the copper price, just like we think like, shares of Apple or Tesla. But of course, prices are not just a point in time, they're a curve. They're a very specific commodity. And really learning those nuances, sort of eventually ended up what we're doing today is, we think a lot of those market structures for commodities are outdated. And sometimes I like to joke that half of the trade is understanding like the arbitrage of the actual commodity commodity contract, or rather than supply and demand. How are people positioned versus the curve and so forth. So, really getting into the weeds, we thought that there was a lot of work to be done as the world changes. Call it the great electrification, energy transition, new commodity sources, whether it's the battery raw materials, or of course liquefied natural gas and everything that's changed in the global economy. And really, the idea was there's a lot of these commodities that the big incumbents, basically ICE, CME, the London Metals Exchange, they weren't really developing products from the first principles as we would in building a copper mine or building a facility, a real engineering approach of what should the modern market structure look like for these commodities. So that's really where Abaxx came about. Kind of the first part was redesigning market structure, and the second part was really about technology, which we can also spend a lot of time on. But yeah, we exist to really be the team that builds the commodity markets for the kind of the next generation.
Yeah, we're going to try and do our best to explain your business because it's not just like a classic exchange that is set up to rival the CME, because there is definitely that tech component. But before we do that, I think you could have just set up as a rival, and maybe do it the same way, but execute a little bit better to some of the exchanges that already trade commodities. But that's a pretty well-established market. I think it's interesting that you're trying to address underserved markets like LNG, like battery metals, like environmental markets, things like carbon credits, and still gold. Like, I know you're still playing in those areas. And then your edge, if I'm right, is saying we're going to do that, plus it can be physically settled, meaning you can take possession. You're not just trading paper. You can take possession. Is that right?
Exactly. Yeah, that's the big problem that we see in the world today is exactly that physical delivery component. So of course WTI famously went negative during COVID, and that's because these contracts are physical. So a lot of the great NYMEX contracts, Henry Hub natural gas, WTI crude oil, the New York Harbor products, these are products that when you're just like the classic old grain exchanges, when your contract comes to expiry, you're taking physical possession of the commodity, and that's incredibly important because it allows for this sort of reflexivity in the market. If the so-called paper market is out of balance with the physical, well, you can always deliver in or take it, and so that really converges the futures market and the paper market to the physical. But unfortunately, what we've seen in the last really in the last decade in particular, is with a lot of emerging commodities, the big exchanges are no longer building physical markets like this. Instead, the different way to do this is through a cash-settled index, and you're indexing a reference price from, say, Platts or fast markets in the metal space. And what that means is there's really not that same reflexivity because you're really just betting at a point in time of what is the survey assessment going to be today. When Platts is calling around the market or fast markets is calling around the market, what is the price of the commodity, and your future is really just betting against that. So you don't have that reflexivity. You don't have that ability to arbitrage the spot market into the futures market, and so that's why we and it's much more difficult to build physical markets, but that's really what we specialize in across our team.
Now, this might be a dumb question, but who wants to take physical possession of LNG? Are these operating companies? Are these speculators?
No, yeah, and there's got to be a lot that goes into your rule book around making sure that only, and also the futures commission merchants, essentially the prime brokers connected to your market, that they understand where the client's positions are, so that you don't get stuck in this position where you've got to take delivery or make delivery when you can't. But yeah, I mean, ultimately, it's the big merchant commodity traders, the Vitals and Glencores and the likes, and and Mercuria, who's been involved in a lot of our deliveries, as well as, of course, the Shells and the BPs and the BHP Billitons. So, the producers, the consumers, and the merchants are really the big players in this physical market. But to answer your question, very interestingly, and it's very relevant to what's going on in the market in the world today, is there isn't, other than Abaxx, there isn't a physical LNG market. So what that means is there's no buyer and seller of last resort, right? So now that Qatar Energy has shut down 20% of their production in the Gulf, that's obviously majorly disruptive to the global LNG market. And there's not a market where I can just hedge that out and secure a different cargo by going long futures and holding them to expiry. So that would be the seller of last resort. Or if the market's oversupplied, I can't just dump into the exchange. That'd be the buyer of last resort. So these markets are very important to help balance the physical market.
Has the business seen a material boost after the events in Iran and the Middle East?
Because we're so new. I mean, our trading really only started last summer. Our volume and our interest has definitely picked up. We've been growing pretty rapidly from Q3, Q4, and now in Q1. But we're not liquided enough yet to really be sourcing cargoes. That'll be coming over the next couple quarters. But kind of every year and every new event that's happened since we've started our business keeps validating the thesis. So we certainly have more interest from traders, but it's, the two sides of the one coin is everyone now sees that you need a new market, but everybody's dealing with the chaos of the current one. So it's hard to, start a new market.
I read a report that BMO started covering you guys and said they see a future where you could own about 70% of the physically settled trading market for LNG in years, right? It does take time as these markets develop. And the backdrop of that is that there's only a few kind of hubs, right now where you can trade. How do you see that expanding? I mean, everybody now, Qatar is one thing, but Russia, Ukraine, like all of a sudden having your own source and your own hub became more important. Do you see more hubs? Does that mean more business for you? How do you think about where the world is going and how you get to participate in that?
Yeah, absolutely. And to answer the first part of the question, just kind of the timing and building that up. Yes, it does take time. But again, because we're the only one with a product like this that can solve these needs, it's now making people rethink what is the price of LNG? How am I going to secure it in a risk management world where we've now had, three, pretty disruptive events even just over the last 5 years with liquefied natural gas. So nothing's really stable in that market. From the Trump tariffs and the export tariffs to China for probably 2 years, Chinese offtake was the main reason why all of those facilities in the Gulf were getting built. And then all of a sudden there's a tariff, and now they can't actually get their own offtake without paying an additional tax. So they now have to sell that offtake, buy it from somebody somewhere else. So again, this level of complexity in the market is exactly why you need a market like ours, so you can rebalance your portfolio and manage the risk. But that's going to happen across commodities. This sort of going from just in time to just in case. And everyone building new inventories, diversified supply lines. That's a trend we think is still in the early innings, and that's exactly why you need new market builders. We can talk about critical raw materials and so forth, but a price assessment of what's happening in China, trading that future in Chicago, is kind of useless. You need the metals. You don't need the price from China. So hedging a price is one thing, but getting the metals needs new markets as well.
I mean, the market's obviously very excited about this. You're still early in terms of the revenue that you're getting, and you're still kind of losing millions of dollars as a business, but your stock is up 240% over the last year. You're over $1 billion market cap, which is a lot. Again, as I said, because the revenue is not there yet, the losses are still there, and you're still in the process, I guess, of assembling that network. What can you tell us about the trajectory, the signups, the participation that you've had over, call it the last year, and how you expect that to continue?
Yeah, it's a good question, and it's interesting because a business like ours isn't usually seen as building long-term infrastructure, like building, oil and gas, facilities or a mine. Like Robert Friedland's, Kamoa-Kakula. I think that took 24 years, right? So these are certainly great businesses over the long term, as you mentioned, like from the BMO report. We do think it's a winner take all type market. Like WTI crude oil, traded on the NYMEX CME, it is about 90% of the volume of oil traded in the U.S. Reference that price and hedge against that price. So it is kind of a winner take all market. And we believe the WTI market's probably worth somewhere in the order of 7 to 10 billion in market cap, for the CME group. And so that's the same type of investment we're making. I mean, it's again, I take this engineer mining executive mindset of you go after the biggest prize with the best team, and you and just stick with it as long as it takes. We think LNG is a $5 billion asset, probably more, but I think conservatively, and so it's going to take some time. We are onboarding a number of key traders, key banks. So you really need to build that network effect before we can get that kind of volume like a CME or ICE. But we're well on our way, because again, the market keeps proving our thesis of why our products are needed.
The stock, though, in 2026 and has taken a bit of a hit. It's down about 35%. What do you think is driving that?
Yeah, I mean, look, we're obviously in a period of price discovery on our equity. It moved up, quite a bit, right up to the end of last year. We were just added to our first, sort of small cap index, and starting, kind of get into those ETF flows, which can really, change things. It also allows people to borrow from the ETF, and there's been a pretty significant short interest. I believe it's something like 40%. Not that I'm, blaming the short sellers or anything, but it is a very interesting when you're going through these re-ratings and the repricing. There's a lot going on in the market, but yeah, there's about 40% of the volume last month, came from net shorts. So there's been a lot of pressure on the stock, but ultimately, we did a fundraising with a very very famous institution, and at the end of last year. So we've got a year's working capital on the balance sheet, and we just have a lot of new products and a lot of new growth this year. So I'm not really too worried about the short term noise. But yeah, obviously it can be a little bit frustrating, watching the share price. But I think there's a lot going on there.
I mean, that's an elevated short position, and again, maybe because you had a big run and the valuation is high, it makes it vulnerable to that. That's kind of why I go back to milestones. Especially this year, next year. What are some key milestones that investors should be aware of? What are you aiming to hit?
Well, so fundamentally, the revenue side, and we should probably talk a little bit how the business makes money overall.
Yes, yeah.
So ultimately, an exchange is very different than like a commodity trader or a broker. We don't hold inventory. We're not trying to make spreads. We are the central counterparty to the whole market, where a bank or again a merchant energy trader will lay off their risk, when they're overbalanced between serving the clients. And so we're really, like I said, that buyer and seller of last resort, and become the futures market. And like a 10,000 MMBtu contract, whether it's our LNG, or Henry Hub natural gas, similar structure. So in Henry Hub natural gas, that's, call it that a roughly $45,000 notional. The CME will make about $1 every time that trades, but that'll trade, millions of lot,
Mm-hmm.
half a million to millions of lots a day. So you're making, anywhere from $500,000 to $1 million a day in free cash flow at scale. So similar type of business for us. Our price is a little bit higher on the LNG, a little bit higher notional, but it's really a volume business. So at the end of the day, it's a very simple business model. Average daily volume times revenue per contract. The difficult part, of course, is building that network effect, building that global scale to compete with the ICEs and the CMEs and the London Metals Exchange of the world, who's had decades to build out their network of trading. So it's all about network onboarding. Growing the revenue through growing products, listing more products, and adding new prime brokers, new futures commission merchants, new trading houses, and so that's really our KPIs every quarter right now. Is what is our revenue from the volume trading, and what is the new network additions we're adding every quarter.
So volume is the name of the game, things that investors should look for. You also mentioned your cash position, which you just did a raise and is healthy. Do you anticipate needing to do another one at some point this year?
Well, we're really just balancing our cost of capital. We've done a number of strategic, non-brokered placements over the last couple of years. There's definitely, very big interest from very important institutions in being part of a market like this. And so we're always watching. It's really a cost of capital. Should we be spending a higher budget than we are now for going after such an important global asset? Again, we think the LNG market alone is probably a $5 billion asset. So, spending right now, we're at, our budget's in the 25 million, and sorry, these are US dollars. Our budget's in the $25 million range. That seems a little light for the return of winning that market. But I'm balancing that against dilution, right? So, for us, if it's a strategic investor that can accelerate our path towards, full liquidity and full revenue on a market like that, then yeah, we would probably invest more. But right now, particularly with the stock under pressure, there's no rush for anything.
Thank you to our partners at ATB Financial. With over $100 billion in assets, ATB Financial is powering possibilities for more than 843,000 financial services clients. ATB Cormark Capital Markets is a leading North American investment firm providing holistic corporate and capital markets advice and full-service financial solutions. Visit atb.com/inthemoney for more information. Now, we've been talking primarily about the exchange business. I spoke to one of your large investors, David Shabanka at Canoe Financial, and he was talking about this ID++ system. And I'm wondering, I know a lot of what we've talked about is already complex, but if in clear terms, you can explain what this other aspect of your business is, because it's not, Abaxx is not just an exchange play. The real material upside, and even though it's more nascent, could be on tech and how you tokenize real world assets.
That's exactly right. And I'm actually right now down in Boca Raton for the annual Futures Industry Association event. And actually, very surprisingly, so this is, again, all of the large market operators come to this event every year. And very surprisingly, almost nobody talked about commodities, despite what's going on in the world. ICE's Energy Breakfast didn't even talk about energy. I find it staggering. So what were they talking about? Gambling and event contracts. They're all getting into the betting markets, which
like all the call sheet stuff, like the prediction markets.
Yeah, prediction markets. So that was probably, over half the conversation was event and prediction markets, and not actually solving real problems in the world. Anyways, that's my bias. But again, it's why we exist. We focus only on physical commodities and the problems we see. But to get to your question, the other part of the conference was all about 24/7 trading and real time collateral. How do you, if we're going to open up markets like the crude oil market, or the particularly with the events in that have happened over the last couple of weeks, you can see a lot of demand for managing those risks over weekends. So there was a lot of talk on that, but the big problem is, how do you move margin? When positions move, are you waiting till Monday? Are you being very capital inefficient and over margining? So the technology
I just want to pause there, because what exchanges do is they can't settle, right, for a couple of days. And so what you're talking about is the fact that they take this trade on a Friday, and as we've learned, by Monday, you're dealing with a very different reality, and then they're exposed as a result. Is that
that's exactly right. Yeah. Right. And so what people have obviously learned from crypto markets is, markets, if you can move collateral like a stable coin in real time, then markets can stay open all the time, right? And we actually saw a large growth in on some of the pure decentralized finance protocols like Hyperliquid. People were trading oil like products. I would argue it's not a it's not a great product necessarily, but it was a way to express a view on the oil price on the weekend, right? So we're seeing it that in the crypto markets that's happening, but for institutional cleared markets, so right, this isn't just hey, if your position's out, you get stopped out and liquidated or rug pulled or whatever like that happens in DeFi. Ultimately, as a clearinghouse, we've got a group of members, large banks, large commodity servicing firms as FCMs, and you're not stopping out a commercial participant. You're giving them the time to have the wire. You're managing the risk as an ecosystem, as a clearinghouse, and so we think those intermediary markets that mutualize that risk so that we don't have these wild stop outs in
Hmm.
markets are very important. But again, how do you do that on weekend? Are you expecting your grain companies and your utilities to be posting margin and stable coins on weekends? So that's where we built our technology around ID++ as sort of an alternative to stable coins. Is how do we move real financial markets assets, whether that's gold bullion, treasury markets, money market funds. How do we take the existing system and move it in real time securely?
And is that
And
product is that product market ready or still in development?
yes, we've had two pilots at the end of last year, and so this was actually the big part of this conference this year was talking to our clearing member partners and our exchange partners, because everybody in the ecosystem kind of has to move at the same time, right? So yes, the plan is to work with regulators and our FCMs to have this live in the market this year.
I mean, I'm looking at a company that's got this possible tech edge and is going into commodity markets that others are ignoring. If I'm a larger exchange looking for fast growth, why don't I just propose a takeover to Abaxx?
Well, look, I mean, our industry is definitely a history of consolidation. In fact, when I met the CEO of one of the big incumbents, he said, "Oh, I've never built a clearinghouse. I've only bought them." So certainly that's a conversation that's always in our industry. But back to where we see our valuation, where we see our roadmap. Look, frankly, we don't think any of the technology, and I think the analysts have said that as well. None of the technology is priced in yet,
No.
and that's just a quarter or two away from being revealed to the market. We think that in itself can actually be a bigger market than the exchange over time, and the fees you collect for moving collateral and holding collateral and so forth. So that's one piece. And then again, like although our current valuation relative to current revenue, even though it's obviously growing fast off a low base, but we're only pricing a small probability of success of ever being, a large exchange that can do 1 million lots a day, for example. ICE and CME, I think, in their in similar commodities are in the 5 to 6 million lots a day. And our stated goal publicly is to be, kind of over the medium term to be 1 million lots a day. So that's somewhere around the 2 million in free cash flow a day. And so yeah, we're not really pricing that in yet. So not ready to be doing anything in the M&A space there.
I want to talk about some of the outlooks on the commodities that you trade, to the extent that you have any. Your board member Jeff Curry, since the Iran attacks, has been out talking about the fact that there's no quick fix to the supply disruption that has been caused by Iran, and who knows what's going to happen in the next couple of days. So it's difficult to predict. But it's been interesting to watch, when gold, which you obviously trade in, is a growth market for you. The reaction is, bullion has been a little bit under pressure. I'm wondering if you have a view on, the trading around gold, the structure around gold bullion itself. It seems like it's a very accessible market, right? Like there's never been an easier way for retail investors to get access, both on a physical or paper basis. What do you think about your edge there?
Yeah, so That is true as far as particularly on the paper side. There's lots of ways to trade gold, but our interest again is back to solving supply chain problems. So one of the comments I made at the beginning is that market structure sometimes isn't as simple as people think it is. One of the reasons why you saw that big blowout in both silver and gold over the last couple of years is, of course, because of the tariffs. Because the spot market is pricing in London, the futures market is pricing in New York and Chicago. But ultimately, the physical market's all out in Asia, right? So you've got basically three different market structures happening, which has created a lot of volatility. One of the reasons why silver got so squeezed there at the beginning of the year, there was plenty of scrap silver. People were finding U.S. dollar minted coins with 90% silver trading 10-20% below silver spot because there's just no way to get them refined. So if you're hedging against a market that is a very specific grade of metal in the U.S., but your actual silver demand is out in Asia, where a lot of the trading and a lot of the buying was happening, you get these big dislocations. So we basically built our silver and gold markets. Well, gold is live now. Silver will be live over coming months, but we built it around Singapore. So a spot market in Singapore, a physical vaulted gold market in Singapore, and a futures market that delivers to Singapore. So we think that Singapore is a much better part of the supply chain for hedging out physical risk, because again, this is where gold is being staged to go to Hong Kong and China or Thailand or Indonesia. So a lot of the growth in the gold market is out in Asia. It's not sitting in vaults in London for the ETF.
And I remember your story as you were coming public. It was during a time where there was a lot of discussions around energy transition. And so you trading, in the environmental markets and battery metals, that's a real hot story at a real hot time. Now there are questions, Canada, for example, you have the energy minister, a Liberal government, saying we need to increase oil production. Like we never thought we'd hear our government talk like that, and certainly we haven't heard our government talk like that in a very long time. Certainly with the Trump administration, ESG, all of that seems to be left by the wayside. How do you think about that? The fact that it's no longer hot and trendy, as it pertains to your desire to grow volumes in these kind of assets.
Yeah, so we've tried to stay in the kind of more regulatory or compliance, side of the market, not the kind of the free for all, pure voluntary carbon market. But there's a couple things that are going on there. I mean, there's still very large companies with net zero commitments. Think about a firm like Microsoft, who is very much leading the charge on net zero and actually being net negative and so forth. Well, now they're going on a massive data center spree. So, if they're going to keep those commitments and not get sued by their shareholders, they're still going to need offsets. So, obviously it's been out of trend with this administration. But, the airline industry under CORSIA, and actually one of the contracts that we have trading is the CORSIA airline contract for phase one. And that's actually been one of the contracts that's been growing volume on our exchange. And in fact, that's one of the few that we're head to head with our big incumbents, and that we're actually the only one that's delivered a physical contract, i.e., a full title transfer of the carbon credits all the way through the clearinghouse. So we are getting well known for being able to design good products in that space, and then we've also launched a number of weather contracts for wind and solar around Texas and Europe. And so we're also, people are hedging their risk for, when the wind's not blowing or the sun's not shining. So we think the environmental suite is still a very important part of the market, that people need to manage their risks. And so we don't take a very political stance. We just, we provide the risk management the clients are asking for.
But has the growth outlook stalled in the current political climate?
Yeah, I mean, yes, I think it certainly doesn't have the same, sort of energy it did, a couple of years ago. But look, as you know, I think we have our Smarter Markets podcast. Where we spend a lot of time talking about the carbon markets, and I think we were always trying to take a balanced approach. Of course, not just Jeff. A lot of us come from heavy industries and
Hmm.
commodities, and we try to take a very pragmatic. Energy security is always going to be on the table, and obviously that's been very proven out the last few years. So we think all forms of energy, including coal, are very important. But depending on the sort of the will of the populace, there's going to be people that are going to want to offset some of the environmental externalities.
It has been an absolute pleasure. Josh, thank you so much for joining us on the podcast.
I appreciate it, Amber. Thank you for your time.